Suter, Director of Personal Finance at AJ Bell, and today I am joined by Ryan Hughes, Investments Director at AJ Bell. We're going to be talking all about the AJ Bell funds today. We're going to look back at 2023 and what happened with markets and the funds then, but also we're going to look ahead to 2024 with an outlook for markets and changes that might be coming down the line for the funds. So Ryan, let's kick off with 2023. How was it?
2023 was a bit of a mixed and challenging year, as we saw different parts of the markets perform actually quite differently. So bits of the equity market performed very, very strongly. Things like US equities were very positive, but Asia and emerging markets were definitely weaker. If we think about the fixed interest market, the bond market, then that was a market of two halves. We saw the first half of the year be quite challenging as interest rates were increasing and inflation was stubbornly high. At the back end of the year, when we saw central banks start pausing their interest rate rises, then the bond market performed actually quite strongly and recovered well into the end of the year. So it was broadly challenging for funds such as the AJ Bell funds, given they have exposure to equities in Asia and emerging markets, as well as the US, and also the different types of the bond market too. But on the whole, finished the year, I think, in reasonably good shape.
So you touched on some of the key themes of the year there, which is inflation, interest rates, but also major US tech companies. They kind of dominated markets. How did that impact the funds through the year?
Yeah, I mean, it certainly varied depending on which of the AJ Bell funds you were in, because the allocation to equities or fixed interest and bonds does vary from whether you're in a cautious portfolio right through to the global growth portfolio. But what we've seen is high interest rates, and that certainly has been a headwind for most types of investment over the year, and high inflation. It's definitely been positive as we've come towards the end of the year that we've started to see the interest rate expectations start to fall. So the market is now thinking about when will rates start coming down rather than how high will they actually go. And we've started to see data in inflation start to fall quite sharply as well. So those things certainly have impacted performance over the course of the year. When we look at the US equity market in particular, it's been very, very dominated by just a few stocks. You may well have heard about the term the Magnificent Seven, which is referring to just 7 large stocks in the US that are all clustered around the technology theme. Now, if you've had exposure to the Magnificent Seven, that's been very positive for investors. And in the AJ Bell funds, we have exposure to US equities and therefore have had exposure to all of these types of stocks. So that has definitely been a help. But broadly, the markets, it's found it quite a tough year to navigate with the interest rate and inflation story. And it's really that pivot point that we got to in autumn, which has started to make investors think much more about what's going to happen in the future rather than what's happened in the past.
So having seen that kind of tipping point in autumn of this year, how do you see 2024 panning out? Do you think we're going to see some of the same issues plaguing us and plaguing the global economy, or is it going to be a totally different story?
I think we are entering a different environment. So the story of rate rises feels like it's largely behind us. And now the market investors are thinking about rate cuts. When are they going to come? It doesn't necessarily feel like they're going to come quickly. But maybe in the back half of 2024, we might start seeing those as the global economy slows down. So data is pointing to slower global growth. We've seen IMF expectations fall, both in developed markets and emerging markets for 2024. Now, that might sound like bad news, but if we think of that from an investment perspective, that means that inflation should be under control, that interest rates should start falling back, and that actually is positive for both equities and fixed interest investments. So yes, it's definitely been a headwind during 2023, but actually I think some of those headwinds might just start turning into tailwinds as we run through 2024.
And so with that in mind and that being your outlook for next year, what changes have you made to the funds to position yourself well for that?
I don't think we've had to make too many changes to think about the environment for 2024. Effectively, we started to make some changes for this new environment at the start of 2023. And so it's a continuation of that theme. So there's a couple of things that we are doing. We're adding a little bit more into bonds, into sterling bonds, so bonds priced in pounds, and taking that from overseas bonds, as the returns we can get from bonds in sterling actually look quite appealing now. Also reducing the exposure to high yield bonds. So they are the higher risk end of the bond market. You're investing to companies that generally are riskier. And we think if we enter an economic slowdown, as it looks like we are, then there is the risk and reward doesn't quite match up there, and it would be prudent to reduce exposure to high yield bonds. If we think about the equity market, probably just one real change that's happening there, which is we're just reducing back US equities a little bit. US equities have had a fantastic year, and actually a fantastic few years. And we feel like maybe just in the future that the returns to US equities might be a little bit lower than we've seen historically. And therefore we're just moving some of the money in US equities into both Europe and Japanese equities, which do look much better value from a risk and return perspective from here.
Thanks a lot for that. We look forward to catching up with you and your team throughout 2024 to look at how those funds are performing and how markets are delivering.